Let's get straight down to business. Today, the parent company of Paytm, its board is meeting to approve India's largest IPO. $3 billion, a valuation of $30 billion for Paytm. You've already seen Zomato file with the market regulator, its DRHP. But what we also understand is that it's not just these two. There is a slew of unicorns, a bunch of unicorns that are headed to Dalal Street. And why not? You got the markets at all-time highs. Just a few days ago, you had veteran banker Uday Kotak saying, look at the capital markets as a gushing river water. This is the time to water up because it may not last for very long. Now, the startup universe was waiting for India to come out with its regulations for direct listing overseas. It was something the government of India had announced in 2020, early 2020. Over a year later, it's clear that the rules will take time. The startups don't want to wait. Indications are the CBDT, the tax department, is not in favor of overseas listing. It's apprehensive about revenue being foregone, particularly capital gains tax when Indian shares are converted overseas, transferred overseas. So in the absence of those regulations, the unicorns are deciding to make the most of it and head to Dalal Street. So Paytm meeting today on that. Zomato's already filed for its DRHP. Others that are in line, well, we understand Policy Bazaar, Delivery, Nykaa, they're all going to be headed to Dalal Street. It's a watershed moment when all of this happens. It'll indicate that the startups have come of age. They're mature enough to be listed. What it's also going to mean is that the public markets are going to have to figure out how to value all of these startups. In India, we don't have the expertise as yet to figure out how a loss-making company, a company that may continue to make losses for a few years, is still a valuable company. How will you arrive at the valuations? How will you make sure that the paper is actually attractive and stays attractive? Will you have overcrowding of markets? Are our regulations up to pace? And how do you all make money from this? These are the new age companies, and now you can be a part of the wealth creation as well. Joining me to talk about all of these burning issues is Ashish, from the IVC, and of course he's the partner at Blume Ventures as well. The lawyer on the show that we have today is Vishal. He's a partner at IndusLaw. He's part of the capital markets division. We're also being joined by Siddarth Pai, the founder of 314 Capital. Thanks guys for joining us this Friday evening. Ashish, I'll come to you first. We knew that 2021 was going to be the year where the startups would come of age and want to become public. The expectation was that they were going to do this maybe at the NASDAQ, maybe at the SGX, but it looks like they don't have a choice, so they're doing it in India. If I could get your initial reaction.
I definitely feel that it's been about 14-15 years of the Indian ecosystem. And looking back from where the markets have come, I think it's definitely a healthy development that we are seeing a pipeline of companies lining up on the Indian markets. The key questions in our heads never were that whether these companies should list. That's the ultimate form of exit that we always have been aspiring. Having M&As between two overpriced companies was never a great idea. IPOs allow the markets to free up cash, with investors being able to get back their money and the system starts rolling over. So I think it's a great timing. The system is coming off its age and peaking out over a decade and a half of its journey. So definitely positive. There are a lot of discussions around companies aspiring for listing overseas, and will have to be there. Both the sides, whether it is listing companies in India and having opportunities for Indian enterprises to list overseas, are going to be required in healthy balance. Not all the requirements of all the companies in India which are unicorns and plus, or which want to tap the capital markets, can be fully taken care of by the Indian markets. There are going to be multiple challenges required. So at some point, the government will have to take a call on balancing its tax considerations, legalities, versus the needs of these companies and the investors participating in these companies. So healthy balance will come, but all in all, I think it's a great start, and it will be great to see these companies go to the markets, discover prices, and hold on and deliver returns to their investors.
Okay. valid points. Siddarth, if I can come to you now. We've seen the venture capital firms, private equity firms create a niche, figure out this segment, figure out how to value these companies. It's a totally different debate on whether the valuations we are seeing are realistic or there's a bubble and all of that. But we've got liquidity as well on our side. But for the public markets, is this going to be a big challenge, you think? Zomato, for example, in its DRHP has conceded, not made a profit, and it's going to be a couple of years before it can even make a profit.
So Nayantara, for this, I think the greatest inspiration for most of the Indian entrepreneurs is actually from the first shareholder letter that Jeff Bezos wrote way back in 1997. It's actually quite prophetic that he's actually retiring as the CEO of Amazon now, just when the entire Indian startup, the startup IPO boom is actually happening. At that particular letter, he articulated that all the money that Amazon is going to make, they're actually going to start reinvesting it into the business. They will actually suffer losses for the initial period, but they will actually gain market share. And once the market share becomes fairly large enough, they can actually start accelerating monetization. Now, if you look at any of the Indian startups also as well, there has been, everybody actually focuses upon the large capital raises as well as the large burns that they've actually had. What people actually fail to see from between the wood and the trees is that these companies have actually become large market leaders and category creators by themselves. Now, the moment that happens and monetization is already started for a number of them, they will actually become cash flow positive, and these companies will actually start throwing out dividends and will actually start scaling up to a very large extent. Now, Indian investors as well have actually been tracking the US markets. They've been tracking the Hong Kong markets and the other markets. They've actually seen these success stories actually come up. So the Indian investor now is actually getting more sophisticated, and all of them are enthralled by the fact that these companies are looking to IPO, so can actually share in those particular success stories as well. The valuation metrics for these, there'll be enough investor reports that actually come out as part of it. There's already analysis being done on Zomato's draft hearing for prospectus. When Paytm launches its own one, they start looking at that as well. The unit economics in all these companies are actually extremely positive. The reason why a number of them actually have losses is because all of them are actually looking to increase their market share against the present incumbents. And the moment they settle upon a sizable chunk of the market, the acceleration in terms of growth will actually reduce, and the prospects of these companies to become more cash flow positive and start throwing off profits will actually increase. So it's a game of patience. The Indian startup ecosystem has been waiting for a very long time for the gold mine of these IPOs to happen. And if the US market is anything to actually go by, we've seen PEs as high as 625x. In those particular markets, India will not have such rich PEs, but we've already seen several large listed Indian companies, especially in the FMCG space, who don't exactly have the same aggressive growth as startups, who actually have a PE anywhere between about 60 to 80. So India is a market that rewards growth, but the Indian investors also become sophisticated enough to actually understand that patience is actually key when it comes to these early growth companies. And the moment the patience will be rewarded by greater capital appreciation in time as well.
Let me go across to the lawyer, Vishal, that we have with us on the panel. Hi, Vishal. Welcome to Startup Central. From a regulatory perspective, the fact that, these will primarily be loss-making, it's an ecosystem that looks at rewards unit economics. From a regulatory perspective, is there any challenge on that front?
Hi, Nayantara. Thanks for having me. So from a regulatory perspective, it's not a coincidence that we're seeing the first flush of the unicorns hitting the market in 2021. Historically, there have been, if I could venture and bucket the challenges which the new age startup companies in India have faced in hitting the public markets, they would fall into the category of regulatory challenges. The other would be to educate the investors and market community at large. The regulatory challenges were by and large in the nature of some of the existing historical SEBI regulations about, for instance, identification of promoters. The regulations in India were very focused on identifying the face behind the entities. And that is sometimes not possible in case of startup entities where the original founders get diluted to single-digit percentages by the time they are large enough to go to the public. There were other regulations such as identifying very specific use of proceeds as to what the company needs to do with the money which they raise in the IPO. Now, again, you can't place the same restrictions or conditions on these new age tech startup companies as you see in traditional Indian corporates. They have no loans on their books. There is little to no capital expenditure. This is essentially cash burn, right? The corporates would raise funds to do marketing. And this was something which was not consistent with the regulatory requirements have been. Over the years, the regulator has come around, identified these issues and taken steps to ensure that these hurdles are overcome. So that regulatory challenge has been overcome, which is why you're seeing the first flush of these new age tech companies, be it Zomato, be it Cartrade, hitting the market. The challenge that, in my mind, honestly remains now is to try and do a streamlined investor education, because even now, the investor community in India is used to identifying and judging the performance of the company based on its bottom line, how much profit it has been making. This is not like how Siddarth was explaining. This is not how we should be looking at some of these businesses. These are completely disruptive technologies and institutions which are being set up, which are going to change the way some of hundreds of years old businesses have been run in the country, starting from fintech to education to healthcare delivery for that matter. So in the short term, the investors will need to educate themselves a lot. So far, it's been a close-knit tight community of private equity, venture capital investors who have had access to the books of accounts of these companies, who have had the benefit of seeing the metrics, be able to determine the performance of the company. Now, as these companies come out in public and expose their books, the investors need to understand the business model and need to be able to identify the right matrices on the basis of which they judge the performance of these companies. For example, in case of, you've spoken about Zomato once or twice. Zomato has been a loss-making company. Their prospectus says they're expected to be loss-making for a few more years. But you should be judging Zomato on different parametrics. For example, look at their average order value. The average order value for a Zomato has been increasing quarter on quarter for the last at least 5 or 6 quarters, as per their perspectives. Now it has reached a stage where Zomato can actually start making money on a per order basis. They continue to make losses, of course, because they're also investing a lot into marketing, expanding, spending on customer acquisition. But over a period of time, that model is going to stabilize and they're going to start generating actual cash, which will reflect in the bottom line. So that is a sort of long-term view with which the investors need to reacquaint and pivot their understanding of these businesses. And it should open the floodgates for other companies to also be able to come and sail their ships.
Well, that's a great point. So let me build on that with Ashish then. Ashish, you've just heard what Vishal, the lawyer that we have on the panel, has to say. That you have to change the metrics, is what Siddarth pointed out for Zomato. He's given us some ideas of how to do it. Tell us some. I know you may not want to tell us all your secrets, so you don't need to. But just tell us that, when retail investors, for example, go out and start analyzing whether it is a Zomato, whether it is a Paytm, whether there's going to be a Policy Bazaar, Nykaa, delivery, and this is just the start, right? What do they need to look for?
So, Nayantara, I think the initial pipeline of companies that deliver on the exchanges and how these companies perform is largely going to drive the success of this vintage. So, eventually, long run, the way we have various indices come up, we have BankX, etc. You will have a startup index also emerging, which talks about how the new age economy gets mapped up. But in the immediate term, I think the investors will have to be willing to look at a combination of cash flow related matrices plus the other matrices which determine the company's market share, the company's traction, the growth rate that the companies have been having, and whether over the next short term of about 24 to 36 months, they are in a position to get to a situation which is going to be cash positive and profitable. So there is going to be a combination of leap of faith that the retail investor will have to take, and also the companies wanting to come and communicate that they are moving on that direction. It has to work both ways. I don't think it will be a great thing for investors to just be asked to be patient. The companies also will have to walk the talk and ensure that they are able to deliver their quarterly performances. And so at the end of the day, when an investor sees that I was anticipating a certain target and the company was talking about a certain number that it had to meet over the next 3, 6, 9, 12 months. As they meet, then people definitely will have much greater degree of patience and confidence in how these sectors shapes up. So I think, just to summarize, it has to be a combination of factors that people will have to look at. And at the end of the day, today when you look at some of the larger investors and they come and price companies at $1, $2, and $5 billion and even beyond that, it's a combination of those factors. There are enough companies on the markets which are moving towards growth investments in their journey. And I think the startups are looking to do the same. So there will be that phase, and retail investors will have to take it in their stride. We won't be able to just look at free cash flows or dividend test when it comes to this vertical. Those things are much farther away in the journey of startups and tech-based IPOs. So it will be more around the other processes and quality of those metrics that will be determining the success of these companies.
Siddarth, if I can now come to you, we've heard what Ashish also has had to say on this front. And I'm going to ask you the same question. I want to get your views as well. Retail investors, when they go in, initially you're going to see the category leaders, right, that are going to go in. Will you also think that this is going to mark the end of the era of cash burn, freebies, cheap customer acquisition? Sorry, expensive customer acquisition, I mean.
Yeah, that's actually true. So actually, it's actually very surprising, but Paytm, MobiKwik, and all these particular companies actually subsidized my entire college life. I had accounts with basically all the wallets to actually get me through, just to actually harvest the cashbacks. But jokes aside, see, all these, if you actually notice, none of these companies have actually had these kind of stellar cashbacks for quite some time as of now. All these usually happen at the earlier stage of the entire journey in order to onboard a larger number of customers before the flywheel actually starts off. And once the network effects start coming into place for these companies, then they start compounding thereafter. So with regard to any retail investor looking at these particular companies as of now, one of the most important metrics to actually study for them is the customer churn, customer acquisition and customer churn. As long as the churn has actually been quite low and the customers have been engaging with the platform for a long period of time, the total lifetime value of these particular customers will become immensely high. And that in turn, once you start discounting all those cash flows that would emanate from those particular customers, you can start getting an idea as to the true value of these companies itself. See, the beauty, the way the entire market and the world actually values technology companies is the marginal cost of providing any service or on their particular platforms is almost zero. Whereas if you look at an FMCG company or something, the marginal cost will always remain constant over time. But when it comes to a technology company, once the initial investment is done in terms of the platform, etc., the marginal cost actually becomes zero. So the gross margins for these companies become exceptionally high, which is why the rest of the world actually gravitates towards these particular SaaS companies and fintech companies in particular. So if you look at a Zomato, you look at a Paytm, you look at a Policybazaar, as of that point in time, look at how they're retaining their customers and they're growing their customer base itself. Look at how the average order value or the average transaction value for these particular companies is also expanding over time because they keep adding additional value-added services that actually comes as part of it. That becomes two. Number three, taking another leap of the Amazon model, it was going to be imperative for them to see whether they have subscription services also baked into their offerings or not. Because the subscription services in turn actually create a sort of mental, I would say it sort of hijacks the mentality of the person to actually start patronizing the same service over and over again. Everyone's seen this happen with regard to Zomato Gold versus Swiggy Super also. But anyone who has a Swiggy Super actually starts ordering more often on that particular app as opposed to Zomato and vice versa as well. So we look at these three particular metrics for the current crop of companies coming up. And as long as these companies are actually growing, then in that case, it'll become fairly easier for them to actually value them. And the reason why patience is actually going to be important to be heard is, see, the moment, because these are untested waters, what may happen when these companies IPO, there may be a slight amount of flux. If people recollect the Facebook IPO way back in the day, when Facebook actually IPO'd out, the stock price actually fell. It took them about 3 to 4 quarters for them to actually recover. And now Facebook has become one of the most expensive companies or largest companies in the entire world. So that's where the patience actually becomes important. It's going to take these companies 2 to 3 years to actually reach a certain state of maturity, where they can actually start competing with the likes of the established banks and the other established players in the market itself. So people have to be patient in that regard and also make a choice. These are high-risk companies. They still remain high-risk companies, but in the world of finance, with high risk actually comes high reward. So everyone needs to understand that they can't go all cards in when it comes to these companies. These companies will add an additional alpha when it comes to a portfolio creation for any retail investor in that. And it's going to be very important for them to actually start looking at it through that lens. And I do suspect at a point in time, you'll start seeing mutual fund and indices start coming out for startups also. And that would actually become one of the better ways for retail investors who may not be as confident in these companies to actually take a diversified bet when it comes to that entire space itself.
Okay, we're run out of time, so I'll have to wrap up. But this is the big story of the day, the unicorns and startups that are rushing to Dalal Street. How are you supposed to value them? How are you supposed to profit from them? We don't have any of these new age tech companies listed on Dalal Street. Yes, you have InfoEdge. In the past, you've had IndiaMart, you've had Just Dial, but this is going to be a big watershed moment in that sense when all of us can also profit from these fantastic companies that have been built by Indian entrepreneurs. Many thanks for tuning in.